We have talked about two consumer-related stocks in my previous video. Have you ever wondered how these stocks always seem to trade at a higher valuation, around 30 times PE, compared to other sectors on the market? In fact, on the KLCI index, which trades the top 30 biggest companies listed in Malaysia, only trades at around 15 times PE. Why are they so expensive? And are they worth it? Today, we are breaking it all down to help you understand what makes consumer stock prices go up. This is so expensive. To grasp why consumer stocks command higher valuation, we first need to understand the two main categories within the consumer sector: consumer staples and consumer discretionary. Consumer staples. These are the essential products that we use daily, regardless of economic conditions. Think of items like rice, cooking oil, toothpaste, and soap. No matter what's happening in the world, people need to use these products to maintain their daily lives. On the flip side, consumer discretionary products are non-essential items that we purchase when we have extra money to spend. This category includes things like luxury handbags, high-end electronics, and dining out at fancy restaurants. While these products enhance our lifestyle, they are not necessities. Understanding this distinction is crucial because it influences how these companies perform financially and consequently how their stocks are being valued. Let's delve into the consumer staples. These companies enjoy a consistent demand for their products. After all, everyone needs to eat, they need to clean, and take care of personal hygiene. This consistent demand translates into steady cash flow for these companies. With predictable cash flow, these companies can efficiently manage their operations and often reward shareholders with regular dividends. For this kind of stocks, a dividend yield above 5% is particularly attractive to investors. If a company's share price drops, causing the dividend yield to rise significantly, it often attracts more investors, leading to a rebound in the share price. This phenomenon provides a cushion against significant drop on the share price. Occasionally, consumer staple companies invest in expanding their production capacity or entering new markets. These capital expenditures are aimed at driving future revenue growth. If these expansions are managed efficiently, they can lead to higher profitability and potentially increased dividend. This growth potential is one reason why these companies often maintain high valuations. To make my point, let's take a look at MSM Malaysia Holdings Berhad, a leading sugar refiner in Malaysia. The company has no doubt experienced a roller coaster ride over the past few years. If you want to find out more about what happened to them, you can watch this video where I interviewed the CEO previously. Now, to help you catch up to speed, in 2022, MSM's share price dropped to around 1 ringgit. You see, MSM Malaysia built a huge new factory in Johor to make more sugar. Unfortunately, the shiny new Johor factory, meant to be a game changer, had become a heavy burden to the company. Instead of running at full speed, the factory was underutilized. This underuse meant they weren't making as much sugar as they could, leading to less money coming in. There were several other issues that caused the factory to slow down. Number one, there were management troubles. The team in charge had trouble running the new factory smoothly. And then there's the issue of high costs. Prices for raw sugar, shipping, and natural gas went up during this period, making it more expensive to produce sugar. And number three, a weak ringgit contributed to the trouble as well. The Malaysian currency lost value, making it costlier to buy materials from other countries denominated in US dollar. That's when MSM Malaysia decided it was time for a fresh start. Enter Syed Faizal Syed Muhammad, the new CEO. Syed Faizal wasn't just any leader. He came in with a mission to clean up the mess and bring the company back to its glory days. One of his first tasks was to tackle the factory's inefficiencies. Imagine a car that's only running on 2 cylinders instead of 4. That's what the Johor refinery was like. Syed Faizal brought in a new team to streamline operations, ensuring every part of the factory worked like clockwork. Slowly but surely, the factory's production capacity began to climb. By 2024, the hard work had paid off. MSM Malaysia's operations were running smoothly, and the stock price, once hovering around 1 ringgit, skyrocketed to over 350. It seemed like the company had finally turned the corner. Just as MSM Malaysia was catching its breath, new challenges came knocking. Prices of raw sugar and natural gas, the livelihood of their production, continued to rise. Every bag of sugar they sold now cost more to produce. These hurdles were too big to ignore, and the company share price began to slip again, eventually falling back to around 1 ringgit. It was a good reminder that no matter how much research you have done to make sure you make the right investment decision, the road ahead can still be full of surprises. Managing the risk of your portfolio is key not to fall into such traps. Now, let's shift our focus to consumer discretionary companies. Unlike staples, these companies thrive on consumers' willingness to spend on non-essential items. A key factor that sets them apart is the strength of the brand. Think of it this way: why do consumers often choose Milo over a generic chocolate drink, even if it's more expensive? The answer lies in brand recognition and trust. Milo has established itself as a household name, giving consumers a sense of consistent quality and taste. This brand equity allows the company to command a premium price. You will notice consumer companies tend to invest heavily in building and maintaining their brand image. This is because a strong brand fosters customer loyalty, allowing businesses to maintain pricing power and achieve higher profit margins. This brand strength is an intangible asset that significantly contributes to the company's valuation. Let's take a closer look at MyNews Holdings Berhad, a prominent player in Malaysia's convenience store sector. MyNews has experienced significant fluctuation in its financial performance and stock price over the past few years. In the fiscal year ending October 2022, MyNews reported a net loss of 3.21 billion ringgit, attributed to challenges such as increased operating costs and competition in the convenience store market. The company's share price reflected these struggles, experienced a downward trend during this period. Recognizing the need for strategic change, MyNews embarked on a turnaround plan focusing on its CU brand stores. This strategy included expanding the product range, particularly in fresh food offerings, and optimizing costs to improve gross profit margins. Thanks to its focus on CU stores and fresh food products, MyNews began to recover. By early 2023, the company's gross profit margin improved significantly and its share price followed as well, rebounding from its low. Investors saw this turnaround as a sign of better days ahead. But like MSM Malaysia, MyNews' journey hasn't been all smooth sailing. Rising costs, competition from larger convenience store chains, and supply chain challenges remain as a threat. These factors have kept the stock volatile, reminding investors that while strong branding and operational improvements can drive recovery, ongoing challenges can still affect long-term performance. For companies like MyNews, a critical metric investors focus on is the same-store sales growth. These measure how much revenue existing stores generate over time. Now, why does this matter? When same-store sales growth is positive, it signals that customers are spending more at existing outlets, usually a good sign of strong demand and effective management. But if the growth is flat or negative, it can be a red flag, suggesting issues like weaker consumer interest or poor inventory management. Very often, these companies will chase the opening of new outlets. New outlets can boost overall revenue, but investors also need to monitor whether these expansions cannibalize sales at existing stores. Ideally, companies strike a balance between operating new stores and maintaining growth at their current ones. If both metrics align, it's a win-win. If well done, the revenue growth can be exponential for the companies. One very good example for this was Starbucks. Have you ever noticed that prior to the Israel-Palestine boycott, Starbucks is one of the very few companies that is able to open 2 stores within the same area, and both stores are able to generate good sales? That's the ultimate dream any consumer companies could hope for. So, why are consumer stocks often so expensive? It boils down to 3 key factors. Number 1, cash flow. Consumer companies thrive on consistent demand, generating steady cash flow and dividends that investors love for their reliability. Number 2, branding power. Just like MyNews or Starbucks, a strong branding builds customer loyalty. A trusted brand allows them to charge premium prices and maintain profitability, even in competitive markets. And number 3, resilience. Both staples and discretionary companies weather tough economic times better than most other sectors. Essentials like sugar remain in demand, and familiar brands offer comfort, making these businesses sturdy during downturns. These 3 traits, cash flow, branding, and resilience, justify why investors are willing to pay a premium for consumer stocks. To find great investment ideas in the consumer sector without falling for unreliable stock gurus, start by understanding the business type. Is it a staple offering stability, or a discretionary stock relying on strong branding? For staple stocks, Check if they pay consistent dividends with solid yield, as high yields often cushion the stock price during downturns. Next, evaluate operational efficiency. A well-run company avoids pitfalls like MSM's underutilized refinery or MyNew's early challenges with CU stores. For discretionary stocks, focus on branding, as products like Milo or MyNew CU stores thrive on consumer loyalty, driving growth. Don't forget to monitor key metrics like same-store sales growth, which reveal how retail businesses are performing. Most importantly, trust your own research. Read financial reports, study market trends, and rely on your instinct to make informed decisions. The consumer sector might seem expensive at first glance, but understanding what drives these valuations can reveal hidden gems. Sometimes, those high prices are justified by strong fundamentals and growth potential. Now that we have explored the consumer sector, let's shift gears. In our next video, we'll dive into the tech sector, specifically a company that's been making waves since Trump's recent election win, MicroStrategy. The stock price is shooting up the roof, but why? What does the company actually do? And can its valuation be justified? We'll uncover the secrets behind MicroStrategy's rise, what it means for tech stocks, and whether this rally is sustainable. Thanks for joining me on this deep dive into consumer stocks. If you enjoyed this video, hit the like button, share it with a friend, and subscribe for more. Remember, knowledge is power, and the more you understand about the market, the smarter your investments will be. See you next time.